Hi, this is James Eng, and today we're going to give a update sort of on the market and also on financing. And we also just had a webinar with close to, I think there was 1,500 people or so registered, and we got a ton of questions throughout the hour. And I figured I run through sort of the top 10 questions that we got during that hour from multifamily investors. So just a little bit about my background. Last 5 years, I've originated close to 800 million in multifamily loans across 125 properties. Also invested in close to 25 properties across DFW, Austin, San Antonio. And then before that, I was a loan underwriter at GE Capital, and then also got my finance degree at UT Austin. So let's just jump in. So this was as of April 15th, sort of where April rent collections were. So everybody was worried about April. And so far in DFW, across sort of probably half of the properties I'm invested in, the B properties are probably right in that 85 to 90% range on collections, A properties north of 90, 95%. And then the C properties are still in the 80s in terms of collections. NMHC did a survey across a lot of the payment providers out there in terms of Yardi, RealPage, those types of guys. And they had about 84% through the 12th of April. And so they did a survey of 11.5 million units, 84% collected so far. Month over month, they were at this time in March, they were at 91%. And then year over year, they were at about 90%. And so about 6 or 7% below where they were expecting, or property owners were expecting, sort of month over month. So here's a financing update. And, Howard Marks said, there's two keys in a crisis. Number one, be insulated from the forces that require selling. And number two, be positioned to be a buyer. And so, in sort of insulating yourself from required selling, I would say number one is an impending loan maturity. And number two is your collections drop so much that you need either forbearance or you get foreclosed on because you can't make the mortgage payment. So let's talk about being insulated from forces that require selling. Number one is if you have a loan maturity probably in the next 6, 12, 18 months, even 24 months, I'd probably be looking at refinancing right now and just sort of see where your position in terms of your property, what type of loan proceeds you could get. And then number two, if your collections are down right now, you should be looking at potentially a forbearance, right? So a forbearance is going to give you 90 days. So Fannie and Freddie are saying, look, we're going to give you 90 days. You don't have to make a mortgage payment, but you cannot evict tenants during your forbearance. You have to pay back the P&I within 12 months. You're not going to get any new loans from Fannie or Freddie, and Fannie is going to cash flow sweep all your excess cash during forbearance, and you're going to have to work with tenants for up to 12 months if they have been laid off, let's say, from COVID-19 conditions. And the second item really is, okay, how am I positioned as a buyer right now? So new loans, let's talk Fannie and Freddie. Those are majority of the loans that are probably going to get done right now. So Fannie has, if your loan is over $6 million, you have to put up a reserve of 12 months, P&I, taxes, insurance, and replacement reserve. This is released after 2 consecutive quarters of 125 debt service, so minimum 12 months. So let's say a $7 million loan, approximately $500,000 in escrow. If it's below $6 million on Fannie Mae, you need 18 months P&I. So $4 million loan, you're probably looking at about $450,000, so close to 10% of the loan amount. Supplemental loans that you could potentially add to an existing assumption is going to require the same reserve requirements. So 12 months, 18 months P&I. If you do a straight loan assumption, you do not have to add those additional reserves in terms of interest reserves. So that is a huge key. But there is also no streamline rate lock. So you have, typically you could have 15, 20 days into a loan application. You could potentially lock the rate with a 2% good faith deposit. You cannot anymore. So you're gonna have to be about a 1 week away from closing, and then you can lock the rate at that time. On the Freddie Mac SBL side, they're doing 12 months regardless. All their loans are about $1 million to $7.5 million. they have this new pre-screen essentially for markets of concern like Houston, New Orleans, Orlando, Nevada, Oklahoma, basically any high concentration of energy or tourism in those markets. They want higher debt service, lower LTV, and the same thing on refis. So they're being a little bit more careful on your refi. So zero point 0.1 higher debt service coverage and a 5% lower LTV reduction. At this time, assumptions, they're not requiring these reserves, but they are going to start requiring taxes and insurance. Whereas before that sometimes could be waived on Freddie Mac SBL. So here are the top 10 questions that we're going to go through. Here's just a snapshot, whether it's loans or buying, and then communication with lenders. So let's just jump right into it. Number one, what are current interest rates on loans? So Fannie, the spreads have come in a lot on Fannie, and they still have the floor 0.9, let's say on a 10-year, plus this has a spread on 10-year about 250. So you're all in about 3.4. Fannie Mae under $6 million loan amount, you're about 30 basis points higher. So let's say 375, 380 on yield maintenance. And then you're about 65 basis points higher on step down. So you're probably about 4% right now. The challenge with Fannie is obviously you have the reserves of 12 to 18 months. And you also you can't lock the rate. So you're essentially going to float until, a week before close. On the Freddie Mac SBL side, we're looking mostly, let's say a 10-year loan at 80%. You're probably in that 4 to 425 range in your top and standard markets. All right. So question number two is what determines the size of your interest reserve, and then how long will it last? So Fannie Mae, we broke it down. So on tier 2 loans, which is majority of loans that we did on acquisitions were tier 2 loans, is a 12 months interest reserve, and then taxes, insurance, replacement reserve. And then on tier 3 loans, you're seeing you go down to 6 months. So 135 cover, 65%, 6 months P&I, 6 months taxes, and 6 months replacement reserve. But then on tier 4, they go away. So if you put down 55%, then you have no reserves. And then all these reserves are going to be released minimum of 12 months, but after essentially 2 consecutive quarters of either 125 or 135 debt service, and they are required on loan supplementals. Freddie Mac is a little bit grayer. You're going to do the 12 months P&I, but then they had a condition that it would be released after federal emergency declarations are lifted for 90 days, and then also hitting your required occupancy and collection. So most loans on Freddie, you're having to do 90% occupied for 90 days. So I think that's pretty much where they're going to have to come in, and it's not required on loan assumptions, these interest reserves. Number 3 is interest only still available. Yes, I mean, Fannie Mae, they're still at 1 year. I would probably model 1 year on Fannie. Freddie, I think, is going to be a little bit more flexible if you're in a top or standard market, probably up to 3 years is their max. So interest only is still available. I have not seen anyone do an 80% loan with 6 years IO on a 12-year term. Most of them are going to be 1 to 3 years on Fannie and Freddie. Number 4, has Freddie SBL changed their lending guidelines? So Freddie SBL has 11 lenders essentially, and those people have a license. And what happened was these people would do the loan and then sell it essentially to Freddie. But now Freddie has come back and said, look, if there is any issue with your loan within the first 18 months, you have to buy back the loan from us. And this has caused a little bit of hesitancy from these 11 lenders, and about half of them have added additional layers of underwriting. And what that means is, let's say Freddie was fine at 75% on a deal. They're saying, we want to do the deal at 70% or 65%, and we want debt service, not 125, but we want 130 or 135 or 140. Essentially, cutting your leverage back on these deals. And depending on the market, they might not even want to be in that market. So whether it's small market or very small market, we've seen some lenders pull back. And so it's not necessarily Freddie. Freddie has changed their lending guidelines that we outlined before, but then this additional layer of underwriting we're seeing at specific lenders on the Freddie SBL side. Number 5, any update on SBL loans for apartment owners? It pretty much has stayed the same. If you're applying for PPP through your apartment entity and all that, majority of that revenue, more than 50% is coming from rental income, which is, I would hope so. You're essentially not going to, get anywhere with PPP. Best bet is to have your third party property management company submit for PPP if they have less than 500 employees. And I've seen that being approved. Now, what's going to happen is the next step is, all right, it's approved, they have the money, but then they're going to have to submit for reimbursement. So what I've seen a lot of management companies do is essentially once they get that loan forgiven, then they will reallocate that back out to the property based on the payroll that they had. Number six, are you expecting an increase in cap rates from Class B and C apartments? I would say yeah. In the short term, uh, there's on these deals there hasn't really been a significant drop in income, right? So the collections on these properties are 90-95% in April, and but there has been a significant drop in what buyers are willing to pay right now because of the uncertainty, because of the leverage points that they're able to have to put up in terms of equity. So let me give you an example. So pre-COVID, there's a 150 unit deal here in Dallas, 900,000 in NOI, and they were getting bids at $16 million. So that equates to about a 5.6 cap. Post COVID, you're close to, they got bids at 14 million, and that was like 2 weeks later. So that, increase of 100 basis points just sort of in a week. So short term, I would say yes, there is a drop or an increase in cap rates, but in the long term, I don't know if there's going to be a huge decrease or increase in cap rates. I mean, I think low interest rates are here to stay. There's going to be a flight to quality in terms of commercial real estate because retail, office, hotels, uh, I mean, those cap rates are going to blow out. There's no doubt about it. But Class A apartments, they've compressed, but not as much. I think those are pretty much going to stay the same, except maybe for the Class A plus that's in lease up right now. There's going to be some shaking out of there. But B and C, I think they will expand in forced situations, right? So when we talked about distress situations, I think that's when those cap rates are going to expand. But if someone has a Fannie loan and they've got 8 years left or 10 years left and they're still making their payment, they're not going to sell right now and they're just going to hold off. And so I think the transaction volume is going to be a little bit lighter, but I don't think cap rates are going to expand by a huge amount in B and C. Number seven, what would you look for if you were a buyer? I would say be open to sort of reallocating your pricing or readjusting your pricing, post COVID-19. So whether that's 15% or 30% off sort of the highs of the last couple of years. Ideally, the seller's in a distress situation, right? Where maybe you can come in, assume their loan and, fix the problem, right? So if there needs to be 500,000 in capital, and then cover your interest reserve for the next 12 months or something like that, or 24 months, just to deal with this turnover, you might need to bring like $1 million to a 100 unit deal to fix the problem. But essentially, you're assuming the loan, you're coming in with limited equity in terms of the purchase price minus the debt, so you're able to fix the deal. So I would constantly be talking with your listing brokers, checking in with them. And then right now, honestly, lenders might have more inside information because they're getting the requests from, in terms of forbearances right now, they're getting the inside information on properties. And so that might be an avenue if I was a buyer. Number eight, which multifamily properties are taking the biggest hit in the current downturn? Two types, I would say new construction deals that are in lease up, right? Because nobody's coming in to lease or is very limited to lease and they're at the top of the market, right? So if people are afraid for their job, that's going to be harder and harder for someone to sign up for a $2,000 or $3,000 a month lease. Your lower income Class C, Class D deal, high crime areas. I mean, those tenants are going to be on a very short budget. And then they probably lost their job in the last 3 to 4 weeks. I would say the ones that are probably right in the middle, stabilized A minus, B plus deals, they're collecting 90-95% of their rent. They don't have an issue right now. But I would say the new Class A deals and then the CD deals are probably taking the biggest hit right now. Number 9, how do you deal with your lender if having to ask for forbearance? Um, I would say right now, everyone should be over communicating and be early. If you see your collections are down, maybe your collections are at 60% or 70% of where they need to be, I would already be communicating that now, mid April, for May, for June, and potentially lead up to a forbearance in those months. Fannie and Freddie have a standard 90-day forbearance with a 12-month payback, um, but no evictions during the forbearance. So that's pretty much a standard agreement. They're going to send it to you. You have to sign it. Whereas your local regional bank, it's going to be case by case, right? So they might allow you to pay it back at the loan into the loan term. They might have a lot more flexibility, and they might be able to give you more time, right? Whether it's 3 months, 6 months, what have you. And then your bridge and CMBS lenders, these will probably be the toughest to work with. So it's going to be case by case. They're essentially the loan has been given to a servicer. They're going to have to follow the loan agreement, right? So this one is going to be more difficult. It's going to take longer. So if you do see a forbearance coming, I would get in front of them right away. Number 10, how often are you communicating with your lender? I would say, give them sort of the state of the market once a month if you don't have any issues, right? So if you're at 90, 95% of your collections, you can still, pay all your expenses, pay your mortgage payment, no issue, then, once a month, just checking in is fine. But if you start dropping to 10, 20% down from where you should be, I would start updating them on, what you're doing, what the status of your collections are, and just be on the radar with them. So keep that dialogue with them if needed, if there is a forbearance needed on that deal. Next up, subscribe to this YouTube channel, like the video. Appreciate any comments you guys have. And if you want to talk a little bit more in detail about a potential deal that you're looking at buying, selling, refinancing, definitely reach out to me, either phone or email. All right. Thanks a lot, guys.